Good afternoon, good evening, and good morning to everybody. And I want to thank all of you for joining here in our third webinar of 2021. And hopefully, like everything else, things are starting to pick up and we'll see a lot of great things to happen for the rest of this year. So I want to thank everybody for taking the time out of their schedule. Today, I'm excited to talk about how SAP RAR and Project Systems take RevRec to the next level. We've known for a period of time that companies are continuing to evolve business models, that we see many more project type business models coming about. And the good news is both SAP Project Systems and SAP Revenue Accounting have really done a lot to improve the connectivity, and we've seen a number of customers begin to really embrace this. And we're going to talk a little bit today about how that's going to happen. So let's do some quick housekeeping. As always, the webinar is being recorded, so feel free to listen in, ask questions, and then share this webinar with your colleagues. Ask questions throughout the session. We will answer them. We have a couple of folks online here that while they're not talking, they can go into the question panel and answer those questions for you. And of course, you can download previous webinars from our homepage on similar topics as well. And we'll be talking, by the way, next week more about lessor accounting, another trend that we're seeing in the industry. So please take the time. In addition to that, I want to give everybody the option or encourage you to contact us. Contact us at bramasol.com. Check us out there, Facebook, or our numerous different places, including our LinkedIn pages. We have some groups out there. You can check our videos out on YouTube, or join us for our podcasts and broadcasts on Apple iTunes or iHeartRadio. So we have a lot to talk about today. We've done our housekeeping. I want to welcome our panelists and the folks that will be speaking today. So again, welcome Julio de la Costa. Julio, thank you so much for taking the time to join us. I know you're having a lot of interesting things going on there in Houston. So thanks for being able to join us.
Thank
Frank,
you, John.
Yeah.
And Frank, here.
It's good to have you here after what's been going on in Houston. We're excited to see you have power and heat and food again. So
thank you.
Welcome to you. Frank, welcome to you as well. You know, we appreciate what you coming to the table and coming from the out east where it's kind of cold out there too. So Frank Josbacher is one of our experts in project systems. And then we'll also be having Haroon Mohammed. And Haroon has been on a couple of our events before. And Haroon is a deep expert in revenue accounting, a former partner with KPMG and a number of other organizations. We'll have Haroon join us. We'll talk a little bit about what has changed in project accounting. And Julio will be covering that together with me. Frank will cover how, you know, what is the next level? What are we talking about? You know, how does SAP do project accounting? But what's really the so what? And we'll hint on that as we talk about things like multi-element arrangements and how SAP and RAR handle that. And then Haroon hopefully will be talking to us about the revenue accounting and how RevRec and project accounting work together and some of the things that we've done there. And then we'll wrap up. So with that in mind, what I'd like to do is introduce my colleague. So, you know, Julio, we talk a lot about a lot of the trends and we talk a lot about different things. You know, we know that one of the big changes that happened in project accounting is this move back. While not a lot of it has changed, certainly the fundamental change was this move from a milestone billing type activity in project cost accounting and project accounting to cost to cost. Maybe you can talk about that and talk a little bit about some of the fundamentals that we're going to cover here and why this is important from a project accounting perspective.
Yes, thank you, John. So I wanted to just give a quick overview because before we get into the system of RAR and SAP, I wanted to give a quick overview so everybody's on the same page and we are a level foundation of what actually project accounting is. So, you know, if you look on the screen, it basically says it's a different accounting process, and it's different because we're using different systems, processes, and standards, right? So, you know, John, in before 606, you know, let's take a step back and talk about that, because people use project accounting mainly to manufacture or large projects. You know, in my previous experience, I used to work for a company that did large undersea equipment, and some projects range from, you know, 5 years to 10 years. So you really have to have, you know, you're incurring significant costs every day for these projects. And, you know, you don't want to wait until you get to the end of 10 years when you finish the production of the equipment, or you finish building it after 5 years. Well, if you waited until after 5 years and you sold it to the customer, you would have incurred 5 years of cost without even taking any type of revenue recognition. So the whole concept of project accounting is to allow companies to basically match cost with their revenues. And how we do that is the topic of this really foundational conversation of project accounting. So just to your point, John, you know, one of the key changes under 606 was milestone billing. So again, let's take my example of you're building a large piece of equipment over 5 years. A lot of companies would just put in their contract, you know, after 25% complete, I'm going to bill you 25%. You know, or let's say you finish the first manifold, I'm going to bill you 10%. That's what milestone billing was. Well, now, because 606 really focuses on the matching of revenue to expenses, you brought a good point up, which is the concept of cost to cost, which is basically, you know, now, because the focus of 606 is essentially, I have to recognize revenue in accordance with the transfer of control. And what is the key word under 606? Transfer of control from myself to the customer. And that is how I'm now going to recognize revenue. So if you understand that definition, you know that milestone billing is an arbitrary, I'm 20% complete, so I'm going to recognize 20%. That has now gone out the window.
Right. And so, you know, exactly. And I think of the old ones, you know, Julio, as you think of milestones, they were some of them were arbitrary, some of them were tied to something. But the other thing that's interesting is, as I think of projects, you know, you would start with the engineering and you would complete that engineering, but it would be a somewhat arbitrary number versus today. You know, you would be able to, you know, you'd say, well, once I finish the engineering documents and the design documents, I bill you 25%. And what this is saying is, no, you can't come up with that random number. You need to assign a cost to that, and you need to track those costs. And what you can recognize is the costs, quote unquote, associated with those design documents that you've now transferred control to the customer. Is that right?
Exactly. So if I have 100% complete of a project, you have to now figure out and do your estimation of, and that is a really good point, John. The engineering documents is usually the first place you start to do the drops, the design of the product that you're making. So once that process is complete, the engineering documentation, what does that mean as far as transfer of control in accounting terms to the customer? So, you know, I'm sure a lot of companies have different ways of estimating, but that's a great point. And it's a good insight into how you actually measure it.
So one of the things that you've come up with is really let's talk about the project accounting process flow. And you've come up with this great diagram here, and maybe you can walk the audience through this, because I think it's important to understand when we move to the next piece and understand what 606 implications are, to have a framework. So, you know, the first piece is, right, initiation. So go ahead.
Yes. Sure. So we have these different buckets of a project. So, you know, in companies that build things, they manufacture big projects, and they may actually build equipment, but they may also include labor, it could include overhead, it could include different cost elements. So the first part of this process flow is the initiation. Who is responsible for what? John, the next one. A big part of project accounting is obviously a budget, because you cannot, the key of project accounting is measurement of progress. So you can't measure progress if you don't have a budget, because at the end of the day, you are going to, every period end, you're going to say, what is my cost versus budget? How much have I actually spent? How much is and in 606 terms, how much control have I transferred? The next one, John.
And what I was going to say is, in order to do that, you have to have a good administrative process, right?
Exactly. So if you look on the screen here, you're seeing you have to have a way to track costs. Costs drive revenues under POC. And you have to be able to track those financial commitments. And at the end of the period you're reporting, you're going to run your billing and invoicing. And that's going to be critical, because how much you track your spending divided by your total estimate to complete, which we call EAC, that's going to give you a percentage of the project that is complete. And then you're going to be able to recognize revenue. So in this situation, it's always good to understand that you cannot recognize revenue unless you have a way or mechanism of tracking your cost.
Exactly. And key to that also is, and one of the things that we found in normal RevRec is allocation. How do you assign those costs, right?
Allocation, and the last talking point on this execution is your measurement. So, we have to understand that even before the accountants get involved, what the accounting department usually does at the end of the month is they would give a call up or send an email out to the engineering department and say, okay, based on your project plan, what have we completed? And that is why measurement of the actual activity is actually important. And if I go back to your example of the documentation of the engineering documents, that is, accountants are not going to be able to say, okay, on this documentation, we are 20% done. No, you usually have to get an engineer to sign off on, we are, based on the project manager, we are this percent complete, and now we can say we are transferred control of 25%.
Mm-hmm. Yep, and then you have the maintenance.
Yes, sir. And then, you're going to, obviously, you have to, once all the data comes in from the various engineering departments. Now, very importantly, I have dealt with projects where you have multi-countries. You have, they're building the manifold in France, they are building another piece in Africa, you are managing it from the US. So this is a multi-country effort as well. So you have to make sure that you have a good mechanism of reviewing, and more importantly, validating the data, and have a good way of managing the inconsistencies.
Exactly, and not only can you have it in different countries, but certainly in many projects. I worked for AT&T for many years, and when we would do the large infrastructure projects, you would have 4, 5, and 6 different business units involved in the entire process. You might be doing an undersea cable combined with switching equipment, and then the wiring that delivers it to the house, and it was all of that work that had to get done. And of course, each was designed and built by different business units, but brought together into a single project. So absolutely.
That's an excellent point, John. I mean, that's an excellent point about undersea cables different, because the thing about what it gets confusing, especially for us accountants, is intercompany, right? How do you allocate intercompany profit across business units, across company codes? It's very interesting.
Right, which leads us to the last one, which is without detailed analytics and analyses, it's going to make your job hard, isn't it?
Exactly. So obviously, at the end of the day, what the accounting department is going to need is, what is the analysis? What is the engineering department saying? How does that translate into accounting? Because at the end of the month, at the end of the period, we as the accountants, we now have to report, here's the actual cost incurred divided by the estimate to complete. And just remember, that estimate to complete is a moving target. So it changes from time to time. Every month, Sometimes your estimate complete can increase, sometimes you can decrease, and that is going to result in recognizing more revenue, or sometimes you have a take back of revenue in that month because you thought you had a bigger, more aggressive target, and now you have to scale it back.
Exactly. All right. So a lot of words on here. We put this up here for everybody so you can get a sense of it. But what's the so what on this slide?
So, John, it's a good point. So the big so what is now under 606, there are only 3 criteria to recognize revenue over time. The first one is the simultaneous receipt and consumption of benefits. That is service. That's for service industry companies. So when I go out, if I'm a plumber and I go out and I do work on your house, I am deemed to be simultaneously receiving the benefit as the plumber does his work. So that's a service-based criteria. That does not apply to POC accounting. The last 2 criteria are applicable to POC accounting. The second one is when you're creating or enhancing an asset that the customer controls. A quick point about this is that bullet was put in specifically by the FASB for federal government accounting programs. In federal governments, when they have contractors build stuff on their behalf, there's a clause in every federal contract that says, even though you're building it for me, I control the asset while it's being created. So that one was put in as a specifics to federal government, the US federal government. The last one is what most companies, people who build stuff on behalf of other customers, use as a criterion to recognize revenue, which is the entity is not creating an asset with any alternative use, and there's an enforceable right to payment. What does that mean very quickly is, if I am, so in my example, when the company I was working for would build an undersea manufacturing subsea equipment in Africa, it was considered that undersea equipment was built at a specific sea temperature, a specific depth. So therefore, that was being built specifically for that customer, for that seabed level. And then secondly, at the end of the contract, I had an enforceable right to payment. So under that guidance, most companies would use that guidance to recognize revenue on a POC accounting.
Got it. Perfect. All right. Well, thank you, Julio. So we teed that up, so hopefully everybody has a perspective. So now let's talk about the project accounting piece of this, because remember, this is a 1 + 1 = 3 exercise. This is new math for the new world, right? But 1 + 1 = 3. We're getting a lot more out of this. And how do we take this to the new level? So I want to introduce Frank Josbacher. Frank is an expert on our team, both in the areas of revenue recognition as well as project accounting. So Frank, why don't you, in the area of project accounting, we have 4 main types of projects. Maybe you can talk for a minute so that we're clear, because each of them has some subtleties as it relates to revenue accounting, right?
Yes. So in terms of customer projects, and so these become revenue projects. For the fixed price engagements, the customer essentially does not take any risks until acceptance. But as Julio just explained, if there's no alternate use for the asset being created, we're allowed to do revenue recognition by percentage of completion. We may have unit-based engagements, and those may be in terms of the quantities greater than 1, i.e., if I'm going to install 7 systems, and I've completed an installation of 6 of them, then my completion is 6 out of 7. Again, one can think of that as a percentage of completion. Time and material, very similar. It's a kind of unit-based approach, and if you have a dollar value to that, then the quantity would be $1 per unit.
Okay.
Finally, we have service or subscription contracts, which are really time-based or start and end date oriented. And so as as time passes, you have a percentage of completion for those.
Exactly. Yeah, and we're starting to see a lot more and look for some more information on subscription contracts in particular, and service contracts and some of our upcoming work, because there's a lot of subtleties to that. Frank, in the area of project systems, there's really a couple of key concepts that people need to understand, and I'm sure some of the folks here, but just to remind everybody, the project breakdown structures and the WBS branches. Now, I think it's important that people understand those to understand the next steps. So maybe you can cover those for a moment.
Yeah, so what happens in the project accounting space is that the billing work breakdown structure elements, which are aligned with the sales document line items as sold, is where the revenue recognition occurs. Okay, so there's only one branch, work breakdown structure branch, for the as sold deliverable or the sales document line item. So underneath the billing work breakdown structure element can be a set of cost collector work breakdown structure elements that report up to that billing WBS element, so that you have the revenue focused on the billing WBS element and then the costs sum to that. I did want to point out that companies organize their work breakdown structure branches in a variety of ways, but that's logically underneath these billing work breakdown structure elements, because again, they need to line up with the sales doc line item. Okay, so whether the customer does it by organization or by product or service or by phase or activity, which is then the real work breakdown structure, in a way, it doesn't matter, because ultimately the costs that are collected in those children sum up to the billing work breakdown structure element, and so that's where the cost evaluation and the revenue calculations then occur.
Great. All right. So each of these has some implications, Frank, as you've seen from the projects we've worked on, and we'll go through maybe the 4 different types. As it relates to RevRec, why don't you take us through that?
Yeah, I mean, what's important is that the relevant costs are evaluated. Okay, so as one looks at the percentage of completion or the progress that then allows for the revenue calculation, it's really the relevant costs that are important. Okay, and again, my point, going back to the previous point slide, is that the percentage of completion is calculated at the billing work breakdown structure element, which is tied to the sales document line item. So that's where the item is sold. And then getting to the RAR side, the billing WBS element, just like the sales document line item, is a revenue performance obligation in RAR. So that's how those are lined up.
Sure. And why don't you take a moment because this is the first time we've mentioned the word performance obligation, and maybe some folks know that, but define that as it relates to this particular aspect, if you would.
Yeah, so when we create a revenue contract with the customer, there are member performance obligations within that contract that are evaluated for their individual completions. Okay, and ultimately, because they are members of the contract, we are interested in ensuring that there is a proper allocation among them, so that we have indeed program gross margin equalization among them.
Okay. All right. So in that case, we talked about fixed price. Talk a little bit about that.
Again, in a way, this points out what I've mentioned a moment ago. So for fixed price engagements, essentially you have an individual or a single sales document line item, which then has a billing work breakdown structure element in the project system. And so you need to understand what your planned costs are, because the planned revenue comes from the sales document line item. So very much as Julio indicated, you have to have your estimate to completion and estimate at complete, right? And then evaluate the actual costs incurred against the planned cost in order to calculate what that percentage of completion or that progress is. and then the earned revenue is then a calculation of that percentage against the planned revenue or the net value from the sales document line item.
Perfect. Okay, and then of course, we have the unit-based engagements. Those are pretty straightforward. I mean, it's based on the units, right?
Yeah, my point here is that these other measures basically also work on a percentage of completion approach, if you will, because if, again, as I mentioned before, if I've sold installation for 7 systems and I've installed 6 of them, I can multiply my 6 units against the unit price from the sales document line item, or the entire value of the sales document line item net value times the percentage of completion, i.e. 6 over 7, right?
Got it. All right. And finally, we have the service contracts or subscriptions, and that's kind of
right. Same kind of thing, except that if you have the per period price, then if a period has passed, then that is the revenue that you can earn.
Right.
Or if you take the entire value of that contract for 12 months, 13 months, or whatever that period is, you can take the periods to date divided by the total periods and get your percentage of completion. Again, multiply against the net value of that sales document line item, which is essentially the planned revenue for that.
Absolutely. And I'm going to throw you a curveball on this one, Frank, so hang on. So could this also be applied to something that we're starting to see a lot of, which is consumption-based models, where the customer signs up to, as part of a project, they're consuming some assets as well. They're consuming, whatever it is. It could be a lot of different things, because if you think of some of the new models that people are coming up with, projects may be related to the consumption of space or consumption of something. Is that possible as well?
If you have a quantity value that is sold, then you can identify, again, this is a unit-based approach, whether it be square feet or anything else, then you can calculate what that percentage of completion or that percentage used might be. I might ask the question, are these going to be projects? Because ultimately what we care about on the project side is the project profitability identification. Because if I don't necessarily care about the profitability of each individual project, then it would be okay simply to have these as sales document line items and have a business level collection of costs.
Yeah. Well, let me throw an example out, and then I'm going to try and unmute Haroon to provide some commentary on here, because he's done a lot of this too. But an example for me might be, let's say it's a real estate project where you're building a building, and towards the end of the process, you're outfitting part of the building, but let's say half the building is able to be occupied, and you can use that space. Right. So could you do something like that, right?
My answer is yes.
Yeah, and let's see if we can. Okay, Haroon, you're self-muted. I'm going to unmute you.
Okay, John, can you hear me?
Haroon, we can hear you. Hello.
Okay, all right, thank you. Yes, John, so I think Julio and Frank have given the pieces about accounting, project-based accounting, and project systems covered by Frank. Now is the time to really connect these two pieces together. John, do you have my slides, or I can talk?
I do. We're gonna get there in a minute. What I wanted to do, Haroon, is get you've spent a lot of time on, seen a lot of these projects. Any thoughts or comments on these specific areas? Something that you've seen interestingly around, these percent of complete fixed price that you've seen in the marketplace, and then in a moment we're going to get to your slides in a couple of minutes.
Yeah, I think in the market, what is very common is cost method of the POC. I think we'll cover in our slide, but I think everything which you see in summary, projects are being tracked, and the percentage of completes are being calculated based on the cost method. They try to see that what is my planned cost in this project and what will be my actual cost over the period of time. This essentially becomes, over the period of time, how you calculate the cost and the actual cost and how you calculate the POC. So I think this slide summarizes everything what I just talked about.
Great. All right. So Frank, one of the key things that's here, and then we'll move into a couple of quick, pictures, and you and Haroon can talk about the pictures, and we'll go through that, is this concept of multi-element arrangements that's, not necessarily well handled in project systems or results analysis, right?
Correct, because in the project system, the results analysis calculates the revenue for each individual billing work breakdown structure element. So if you have a fixed price contract and you have a single sales document line item associated with that, you have a single WS element, billing WS element for that. But if you have several of these, okay, it could be that each one of them, which earns revenue on its own behalf, if you will, has a different progress, okay? And so our results analysis will figure that out for each one of them, but it doesn't do that for the entire project. And this is where RAR comes in. So again, my little check mark at the bottom says RAR is the answer.
Great. All right. So quick diagram here. We have the POCs, and we'll get to Haroon's slides in a moment. Talk about this from your, we're going to have Haroon talk about the RevRec side of this equation. Why don't you talk for a moment in the case of POC around the RA side of this?
Yeah, I mean, clients are interested in understanding how the integration between the project system and RAR actually works. And ultimately, as this diagram shows, we have a sort of a three-step process where it comes for those performance obligations that are based on the percentage of completion progress measurement. Okay, in a moment we'll touch on the time-based ones. Yep. All right. So here the point is that step one over on the project system side with the results analysis, the percentage of completion is calculated just as it is today. Okay, for each billing work breakdown structure element for, again, each POB. That is sent over to RAR, and it then uses that percentage of completion to do the revenue recognition calculation and the revenue adjustments according to the allocations between the performance obligations, and then sends revenue adjustment data back to the project system because it doesn't know about that. Okay, so at this point, the PS data has been enhanced with revenue adjustment data from RAR, and then it can do its settlement. What's important is to distinguish where the revenue then flows. So the earned revenue and revenue adjustments go just as they do today from RAR into the FI general ledger. And on the PS or the results analysis settlement side, only the costs are then fed to the general ledger as cost of goods sold, and COPA is then given the enhanced revenue as well as the cost data from PS.
Right, and then as you mentioned, we have the other scenario, right?
Right. So where there are projects that are revenue based, or excuse me, time based. So they have a revenue priority. Now, why do we have such projects in the project system? Because we want to collect their costs. Okay. So on the one hand, historically, results analysis has performed the time-based revenue recognition in PS. But now under the scheme of integrating them with RAR, essentially the revenue accounting is done first, okay, such that the revenue calculations as well as adjustments are determined in RAR and obviously then posted to the FI general ledger and also fed over to to PS for results, the regular results analysis processing. But again, the revenue is, shall I say, enhanced. It includes revenue data that is not available normally in PS. It comes from RAR and now results analysis and then settlement process that. Again, settlement only feeds the cost data for those time-based projects to the general ledger, but then both the cost and revenue to COPA.
Right. Okay. Great. So, we've talked, Frank, and thank you. We've talked a lot about this area, and of course, the big so what about this is the RA, the revenue accounting side of this, and RAR is the source for a lot of that data. So, with that in mind, Haroon, let's talk about your side of this side of the equation, and it's a similar chart, a little bit different. But Haroon, if you can talk a bit about the RAR side of this and why it makes a difference, and what's going on from that perspective.
Sure. Thank you, John. So if you see, there are two really essential systems which are integrated: SAP Project Systems and SAP SD with RAR. SD is sales and distribution, where you have orders and contracts. Project Systems is the system where you have projects, work breakdown structures. If we just spend 1 minute in the integration so that we have a big picture clear, that SAP SD has order and contract, and which has an account assignment of work breakdown structure. So that way you have sales and distribution and project systems integrated. On the other hand, you have SAP revenue accounting and reporting to comply with your ASC 606 reporting. And these three systems now are integrated. SAP RAR is integrated from two sides. One is from SD side, another one is from project system side. And as Frank has covered, percentage of complete. And if you see in this slide underneath, it's called results analysis. The results analysis is the main integration point for SAP RAR. And if we want to really see how revenues are calculated, this is essentially for the project system-based revenue. I mean, in the past, if you see, the revenues have been calculated in the project system and sales and distribution module are in combination of SD and project system. They were essentially ASC 605 aligned. They were not giving you revenue with the new revenue standard. And when RAR was integrated with project system and SD, that is when you have started getting the revenue in ASC 606 standard. So there was a question, I think, from the audience that what's about the cost? So as we know that the SAP project systems, initially captures the cost. SAP project system is not built for revenue accounting and reporting. And when you capture the actual cost in project system, whether it is labor cost or you have a material cost or expenses, and you lay over the planned cost, because whenever you have a project, you always estimate what is my planned cost. Once you have these two data set, actual cost and the planned cost, you can calculate percentage of complete. Now these projects definitely have a start and end date, right? This project could be for 1 year or 3 years. And since you do not complete the project overnight, but you still spend time and material over the period of time, you are supposed to calculate or recognize the revenue according to the effort you have put in those projects. And that is why this is aligned to the ASC 606, that as soon as you have completed a certain percentage of complete, then only you recognize the revenue. And in my next slide, I'm covering that as an example, because this is more, talking and in theory, but in the next slide, it will show you how it is calculated. John, can you go back to one
Oh, you want to go
back
back?
slide for a moment? Yeah.
Absolutely.
For the folks who are very technical in the audience, I think I have put these 2 bullet points down below, that how SAP project systems and SAP RAR are integrated. There are 2 configuration nodes are given by SAP, and these are the tables I have given that you basically enable those tables to integrate SAP project system with SAP RAR, and this is purely for the technical folks who are in this meeting. Now, another point, if you see in this graphics, I have also mentioned performance obligation and allocated revenue. So SAP RAR, if you think about, or if you remember what Julio and Frank mentioned, I think they spoke about performance obligation and allocated obligation, but allocated revenue is something you have to do across the performance obligation. For example, if you have 4 performance obligation, according to new revenue accounting standard, you have to allocate these values across performance obligation. And one more thing we have to remember, that performance obligations are not created in project systems or SAP SD modules. They are going to be created in SAP revenue accounting and reporting based on the SAP sales and distribution sales order line item, and in those line items you will have to enable that what line items will work or will function as a performance obligation. So there is a lot more configuration and integration goes behind that, but at the high level we do have a performance obligation. There could be a multi element arrangement, or there could be one performance obligation, and then you allocate the revenue, and that is what we are calling it allocated revenue. Because when you calculate the percentage of complete and when you recognize the revenue, you do it on the allocated revenue. You do not do it on the transaction value alone.
Absolutely.
So we'll go to the, yeah.
And maybe you can comment for a moment, Haroon, because I know you know a lot about this, but a lot of these projects, as Frank pointed out, things change, right? The timelines can change, they can move up and down, the costs, planned cost versus actual cost, a lot of that changes and could therefore have an effect on allocated revenue, correct?
Yeah, it will have an effect on multiple things, John, depending on what is changing. If you are changing only the cost, plan cost and actual cost, it will change your percentage of complete, and it will change your recognized revenue. Allocated revenue comes based on your transaction price and standalone selling price purely. So they will not get impacted directly just by the cost unless you go and touch your transaction price.
No, yeah, that's a great point. And partly sometimes we do see, obviously, we talk about in the revenue accounting space this concept of contract combinations and contract modifications. That is entirely possible in a project systems environment where you may add or change some of the elements within the project, and therefore it would then have an effect on the allocated revenue, correct?
Yeah, it will have, depending on what exactly you are touching, because remember, project systems mainly contains with the costing part. So right, so what you can play with is your costing part in the project systems, and there are certain limitations, and we'll address those limitations after we are done with the second slide.
Okay.
But when it comes to modifications, you know, if you have a project, you can change the start and end date. That way you are basically touching the start and end date in your sales order and ultimately to the revenue contract. That will have your contract modification triggered at that point of time, essentially because you are shortening or you are lengthening the duration of the project. Yes, of course, they will have a significant effort on the contract modification, and that will impact your allocated revenue as well.
Yeah, well, let me ask, I'll ask it in kind of a, because you guys are deep experts, right? So I'm going to ask it kind of in a dummy way, right? When I go back to many years ago, I had a project and I had an addition put on my house, right? And I had a scope for that project. There was, by the way, milestone billing associated with my project, right? 25% up front then there was a piece when they buy the flooring, for example, or they buy different things. There were milestones, but all along the project, there was everybody's favorite phrase. Well, while you're at it, you might as well do this, which added to the scope of the project. Would that have an effect in your perspective on this allocated revenue? And I guess my real point is, project systems, and we'll talk about this in a minute, project systems is well designed to manage costs and projects, but it's RAR that was designed to handle the revenue recognition side of that. And I guess what I'm trying to get to is your thoughts on that coming together. And I think you're going to take us through that in this example, right?
Yeah, but that is a great question, John, that you are asking a very, very different kind of question. And those are really going to be very helpful for the people who are implementing RAR with the project systems. Because what are the changes in the project system can trigger the changes in the revenue accounting and reporting module. Now, what we have to understand clearly that there are various specific criteria given by ASC 606 that what will constitute contract modification in SAP RAR, Revenue Accounting and Reporting, which can align to ASC 606. And those are, you can change the duration of your contract, which obviously you are in the back end, since project system is there, you are essentially changing the duration of your project, right? Mm-hmm. So if you change that, if you are bringing those kind of changes, you are essentially doing a contract modification. Once you do the contract modification, your allocated revenue, allocated price will obviously get impacted, because if you change the duration, what you are saying, either you are changing your contract price as well, or you are not changing the price, etc. So there are several factors which will contribute to what you are changing in contract and project system in order to change the allocated revenue.
Right. And so anybody who's out there thinking that a spreadsheet's a great way to do this, not so sure, right? So.
Yeah, I think if you do not have SAP RAR or any other ASC 606 aligned tool, and if you have just project systems or SD module, you have so much manual work which you do. And John, you and me were with a number of clients where we know there is so much frustration and anger when they do the month-end closing and quarter-end closing, and they have to allocate 2 to 3 people purely to really crunch the numbers to align
Absolutely.
with ASC 606.
And the minute they want to change their business models or acquire new companies, it becomes even more complicated. Yeah.
Yeah, it is. And good thing about what we are talking about is, SAP RAR is natively integrated with project system. So if someone has the project system as a client, I think there are 2 sets of configuration which are very easy in nature, which I have mentioned below. Once you enable those, SAP RAR gets integrated with project system, which is nothing but at the back end is a results analysis, what Frank covered briefly.
Mm-hmm. Mm-hmm. All right. So your next slide, let's talk about that.
Yeah, next slide is essentially, it's a summary of everything we have been talking about. And remember, this is a very simplistic layman kind of example I have put together, because the actual example, if you have a multiple POBs and multi-element arrangement, could be more complex than this. But let's see this example very briefly. So let's say you have a sales order, you are using sales and distribution module, and that sales order goes through so many other processes. We'll not go through that because that will get confused. So let's say this sales order, it goes to RAR and it creates a revenue contract.
Mm-hmm.
And in that revenue contract, our allocated price is $1,000 just for that performance obligation and that revenue contract. Now, this basically shows you the integration between sales order and RAR. Now let's go to the next part, which is project system. Let's assume project system has a planned cost of $100 for that particular line item of the sales order. What we have to note here that sales order has a line item, and that line item will have a WBS element as an account assignment, and that WBS element's planned cost is $100. That's what we are saying. Let's say as you start working on this project, you have charged the time because there is a labor which is working. Let's say there are some expenses or materials. The total actual cost of the progress, let's say in 1 month, is, for example, $10. Now, if you see, we have a planned cost of $100. We have an actual cost of $10. Essentially, if you see at high level, the progress seems to be 10%, and that is what we are calling percentage of complete, which is calculated by a results analysis method in the project system. Now, in the case where you have just made a 10% of the progress, what SAP RAR does that, since SAP RAR is integrated with the results analysis of project systems submodule, it will say that, well, since I have allocated a price of $1,000 and we have made a progress of 10%, I will recognize the revenue of $100. So in this purely case, if I want to see what will be my recognized revenue, it will be $100 in this case. That is the example. Very simple example.
Very straightforward, but now, and you make a great point. It's spot on. Now imagine, I know everybody's looking at, well, that's a pretty simple example, but imagine that you have several POBs. It could be, in some of these cases and customers we're dealing with, you could have hundreds of POBs in a single sales contract, and a single revenue contract. Imagine trying to do all of this without a tool like RAR and project systems working together. So the complexities. So thank you, Haroon. Julio or Frank, any thoughts, comments on that?
I think I just wanted to go back to what you were asking about, the changes that occur to a particular contract. Again, the questions are the additions independent, in which case they might be distinct line items. They might not even be part of a project themselves. They may simply be a material that gets delivered to the customer. Others are, in fact, either an enlargement of an existing deliverable or maybe a reduction, depending on what the customer is looking for. In which case, yeah, the planned cost for that particular performance obligation does change, and therefore, even if the actuals are the same for the data date, the value of the earned revenue is going to be affected.
Sure. Okay. All right. Well, with that in mind, everybody, we're running out of time. I just wanted to thank Frank, Haroon, and Julio. As always, you guys did a fantastic job. We do know that we have lots of clients who are moving in this direction. A lot of positive things have happened, particularly in the S/4HANA space, where the integration is almost real time between these modules, of course, and you can take the power of the S/4HANA program there. But in addition, obviously 606 had an impact. We talked about that in the beginning, and we talked about the fact that we moved from a milestone billing to this cost billing. Frank talked about the project systems and how it handles projects very, very well. And there are a lot of elements in there. However, project systems was never meant to handle revenue accounting. And this is particularly as it relates to things like multi-element arrangements where you have multiple POBs. Haroon rightfully pointed out very spot on that project systems and SD traditionally handle or do handle in a 605 methodology, and therefore even if you use these two tools independently, you're still converting from a 605 methodology to 606. There's a lot of manual work. Why not take advantage of the tools that are better handled in RAR for the allocations, contract combinations? You may have things like variable consideration. There's a lot of different elements as you think of the costs, right? We think of costs in the RAR space, for example, commissions, but in the project space, another cost that would have to be allocated and thought about is performance bonuses or penalties, and how those relate to variable consideration, and how those can be handled both from a revenue accounting perspective and need to be carved out. So again, many different aspects of this project. And RAR and project systems were designed or now work very well together. In the early days, there are a lot of customers out there who, RAR and PS did not talk well together, but they do now. And we have a lot of tools and a lot of practice in helping companies take advantage of that. And if you want to see how these go together, check us out. We have a couple of other videos up there, but we're going to have some project systems RAR integration videos available for you to see, not only from how the two tools work together and share information amongst one another or between one another, but some of the reporting tools that are available to you. So with that, again, I want to thank everybody for joining us. We did have one question on here, and maybe if we have one moment to maybe answer that question. MEA is a multi-element arrangement. And for those of you who don't know what an MEA is, multi-element arrangement means a combination of different things. So for example, in a simplistic example, your cell phone, when you go purchase a cell phone, you get the cell phone, you get the service, you get a warranty, you get an upgrade. Normally, all you do is buy the cell phone, but that breaks out into these multi-element arrangements. And the same can be true, obviously, for projects. One question that's here, guys, and I'm not sure how to answer it is, can more than one accounting principle be mapped to an RA key version? And then how are they mapped to lead and parallel ledgers, et cetera? So can you have more than one accounting principle mapped to an RA key? We know that RAR can handle more than one accounting principle, whether it's US GAAP, IFRS, German GAAP, but how does that relate, Frank and Haroon, to project systems?
Well, in PS, you would have distinct RA keys in any case. So ultimately, you're still dealing with a mapping between them and the RAR.
Right, and then when they come over, if we were using those, we could identify them in the beginning through, so for example, maybe BRF Plus or different tools to map those to the right accounting principles in RAR, correct?
Correct, and if they can or should be ignored, they can, yes.
Excellent, spot on. All right, so hopefully, Ramesh, we answered your question. With that, I want to thank everybody for your thoughts. And Haroon and Frank and Julio, as always, it's been a pleasure. Everybody, again, check out the website. A reminder that Bramasol is the leader in business and finance transformation for SAP. And we are the deep experts in revenue accounting, project accounting, as you can see. And so I encourage you to check us out. Come to the website, reach out to us with any of your questions or comments. And I just want to remind everybody in these times, please stay safe. Please practice social distancing as appropriate. But we are here to support you, and we look forward to working with you all in the future. So make it a great day. Thank you.
John, there is one more question. If you don't mind, I can address
question.
it.
Look at that.
Yeah. So there is a question from one more audience, that how is cost recognized simultaneously with the revenues in POC? I thought that is a great question in project system. That really comes quite often, because it is not visibly seen whether project system can do the cost recognition. And there are really some underlying complexity. So I will quickly address that. But obviously, you can always reach out to me for the detailed answer. When we say how the cost is recognized, remember that we calculate the POC based on the actual cost. So we, over the period of time, the labor charges, the material charges, essentially constitute your actual cost. And that actual cost is nothing but your cost recognition, because that is what you use to do the revenue recognition. Now, according to matching principle, you recognize the cost and revenue at the same time, and there is some gap in SAP how it is being recognized. So as I said, there are some nuances to this cost recognition. Second nuances is that even though you have calculated the POC through the cost and you want to delay your revenue recognition, so although the cost is recognized, but the revenue will be deferred and will not be recognized, and this does not satisfy your matching principle. So there is a way to really overcome that, and as I said, there are more details around that, but this is a great question. And if I think John, we can address it when we get together with the audience if they want to reach out to us.
Absolutely. But please feel free. Thank you, Harun. I'm glad you mentioned that. All right. We'll give another second because we had a second question jump in there. So, all right, everybody. Well, we'll wrap up. Again, thank you so much for everybody's time. Harun, thanks for jumping in there and grabbing that question. And we'll look forward to seeing everybody on the next webinar next week. Make it a great day.
Thank you.
Thank you.